You know, we all talk about insurance, don't we? It's kind of crucial. You probably have a policy, maybe two, car, home, maybe health insurance. But have you ever, really stopped to think about what it really covers? Or how all those different types are actually designed to protect you when, well, life happens. Welcome to the deep dive. Today, we're going deep, trying to get you well informed, fast, on a topic that really touches almost everyone: health and general insurance. We've gathered some really insightful stuff, and our mission today is basically to turn all that dense, maybe technical info into something clear, something you can actually use. We're going to unpack the different kinds of insurance, critical illness, motor, home, all that, highlight some maybe surprising facts, and help you grasp the core ideas that make insurance work. Okay, let's get into it.
Yeah, absolutely. And when you think about the financial hit of a really serious illness, it can be massive. That's really where critical illness cover, or CIC, comes in. What's fascinating here is how critical illness cover provides a lump sum, giving you immediate financial flexibility when you need it most.
Exactly. Yeah, imagine getting some, life-changing diagnosis. The absolute last thing you need is worrying about money, right?
Yeah.
How to pay for care or change your house around or just, manage day to day. So CIC steps in. It gives you this tax-free lump sum if you get diagnosed with one of a list of specified serious conditions. Our sources mention the typical ones like most types of cancer, heart attack, stroke, coronary artery disease needing surgery, major organ transplant, MS, kidney failure. Quite a list.
It is. And it's important to note that the Association of British Insurers, the ABI, they sort of guide the industry on this. They set minimum standards.
Yeah.
So they specifically require cancer, heart attack, and stroke to be the core conditions in these policies.
Right, the basics. But some policies go further, don't they? They might cover things like paralysis, blindness, loss of limbs, stuff like that. Though I guess you always need to check the small print, because the definition of, say, total and permanent disability could be a bit different from one company to the next.
That's a really good point. Definitions matter. So if someone gets this lump sum, what do they typically use it for? Well, it's incredibly versatile, actually. People use it for long-term care, maybe in a home or hospital, or for making necessary changes to their own home, buying special medical equipment, maybe helping with the mortgage payments. And crucially, it can just give you that bit of financial breathing room to, enhance your quality of life during a really difficult time. It's not just about the medical bills.
That flexibility sounds key. Okay, let's shift gears a bit. Income protection insurance, or IPI. This one's all about replacing your income, right? If an accident or illness stops you from working and earning, it helps cover your normal living costs, maybe even things like childcare fees or paying for help around the house if you can't manage.
And one of the really crucial bits to understand with IPI is something called the deferred period. This is basically the waiting time, the gap between when you first get ill or injured and when the policy actually starts paying out. It can range from, just 4 weeks up to 13, 26, 52, even 104 weeks.
Wow, up to 2 years.
Exactly. And if we connect this to the bigger picture, understanding the deferred period is crucial for managing your out-of-pocket expenses right after a claim. Generally, choosing a longer deferred period means cheaper premiums.
Okay, that makes sense. A trade-off. So for someone looking at IPI, what else really affects the cost? What drives that premium?
Well, your job is a big one. Insurers put jobs into risk categories, usually 4 classes. Class 1 is the lowest risk in accountants, office workers. They usually get the cheapest rates. Class 4 is the highest risk, maybe industrial chemists, construction workers, that sort of thing. Then there's your age, obviously, the amount of benefit you actually want, your current health, any past medical issues, and as we said, the length of that deferred period. All those factor in.
Right. And when you look at policies, you see these terms: reviewable premiums and guaranteed premiums. So what does this all mean for you, the person choosing?
Good question. Reviewable premiums, they start lower, seem cheaper initially, but the insurer can review them, usually every few years, and they might go up. Guaranteed premiums are, well, guaranteed. They cost more upfront, but they stay fixed for the whole policy term. So more certainty, but a higher initial cost.
Got it. And how much income do these policies typically replace?
Usually aiming for around 50 to 65% of your pre-disability earnings for an individual policy. Group policies, like through work, might go a bit higher, maybe 75%. There's often also a feature called proportionate benefit. This means if you can go back to work, but maybe only part-time or in a lower paid role because of your condition, the policy might pay out a proportion of the benefit to help top up your earnings.
And the tax side of things, are the payouts taxed?
For an employee on a group scheme, the benefits are usually tax-free. If you have your own individual policy, the premiums themselves aren't tax deductible from your income tax, but the benefits you receive are usually tax-free when paid out. Sometimes, if you're self-employed, the premiums might be claimable as a business expense, though. Worth checking that.
Okay, let's unpack this next one. Accident, sickness, and unemployment insurance, or ASU. How is this different from IPI? ASU seems more like a general insurance product. It's mainly for covering monthly mortgage payments if you're ill, injured, or, importantly, made redundant. But the key thing seems to be it's short term, right? Usually covers you for maybe a maximum of 1 or 2 years.
Exactly. And that's the big difference from IPI, which is designed for potentially long-term income replacement. This raises an important question about how these different policies really target different financial needs and durations. ASU benefits usually kick in after about a month, that deferred period again. And like you said, it's typically geared towards that monthly mortgage payment, not a wider income replacement or a lump sum.
And there are specific rules around the unemployment part, aren't there? Our sources say you need to have been working continuously for a minimum time before you took out the policy. And, critically, if you had any inkling redundancy was coming when you signed up, you won't be covered for that. Plus, obviously, no payout if you quit your job or get fired for misconduct.
That's right. Those exclusions are important. Tax-wise, ASU benefits are tax-free when you receive them. But there's no tax relief on the premiums you pay for a personal policy. If your employer pays for it as part of your benefits package, then it's treated as a benefit in kind.
Okay, so that means it's like extra income for tax purposes, even though you don't get the cash.
Precisely. The taxman sees it as part of your overall compensation.
Right. Okay, next up. Private medical insurance, PMI. This one always generates a bit of buzz. It's designed, essentially, to cover the costs of private medical treatment, so you're not solely reliant on the NHS.
And what's fascinating here is how PMI offers choice and speed, fundamentally changing the healthcare experience for many. The big advantages are things like avoiding NHS waiting lists, getting to choose your consultant, choosing the hospital, often higher quality accommodation, like a private room, and just more flexibility about when you have your treatment.
Here's where it gets really interesting. Those benefits sound pretty appealing. So what costs does PMI actually cover?
Typically, it covers inpatient charges. So nursing care, the hospital room, operating theater fees, drugs, dressings, that kind of thing. It also covers surgical and medical fees, the surgeon's bill, anesthetist, pathologist, radiologist, and often outpatient charges too, like consultations with specialists, maybe some therapies, even home nursing sometimes.
Okay, quite comprehensive then. But the cost must vary a lot. What pushes the premium up?
Location is a big one. London treatment costs are significantly higher, so London-based policies are usually more expensive. The type of hospital matters too, maybe a central London teaching hospital versus a smaller private one, the level of accommodation you want. And like most health-related insurance, your age is a key factor. The older you are, generally, the higher the premium.
And the flip side, what does it not cover? What are the common exclusions people need to be aware of? This feels crucial.
Absolutely vital. The big one is usually pre-existing medical conditions. If you already have a condition when you take out the policy, treatment for that condition often won't be covered, at least not initially. That's why getting PMI before issues arise can be beneficial if you're considering it. Other common exclusions are things like routine eye tests or dental checkups, routine pregnancy and childbirth, chiropody, treatment for self-inflicted stuff like alcohol or drug abuse issues, cosmetic surgery that isn't medically necessary, and usually alternative therapies like homeopathy or acupuncture aren't covered either.
And tax?
Generally, the premiums you pay aren't tax deductible personally, and the benefits, the treatment costs being paid, aren't taxed. If your employer pays the premium for you, they can usually deduct it as a business expense. But for you, the employee, it's that benefit in kind, again, taxable value.
Right. Okay, moving towards later life now. Long-term care insurance, LTC. This feels increasingly important. It's designed to provide money for care when someone gets older and maybe can't manage basic daily tasks anymore. And the need seems to be growing, doesn't it? Families are perhaps less able to provide that hands-on care. People are living longer. We expect a better quality of life. And there are worries about how much the state will provide.
That's exactly right. And this demographic shift, this longer lifespan, it really raises an important question about how society adapts to an aging population and the role of financial planning in that. With LTC insurance, the amount of benefit you get usually depends on how much care you actually need. And that's assessed by looking at your ability to do basic activities of daily living, or ADLs.
ADLs. Okay, can you give us an idea, like a checklist for independence?
Pretty much, yeah. Think of things like washing yourself, getting dressed, feeding yourself, using the toilet, just moving between rooms, even preparing a simple meal. The policies usually specify you need to be unable to do, say, at least 2 or 3 of these ADLs independently to trigger a claim.
So it's not just about needing full-time nursing home care. You could still be at home but need help.
Precisely. You might just need someone to come in and help you get dressed in the morning or make your meals. That could still trigger a claim, depending on the policy wording and how many ADLs you struggle with.
And the benefits, how are they taxed? Is it complicated?
It can be a little. Benefits from a standard purchased life annuity used for LTC are generally tax-free. If it's what's called an immediate needs annuity, bought when care is needed right away, the benefits are tax-free if they're paid directly to the registered care provider. But there's a catch. Any part of that payment considered interest is usually taxable as savings income.
If you've got a pre-funded policy, when you paid into over the years before needing care, then typically both the premiums you paid and the benefits you receive are tax-free.
Okay, that's a lot on specific health covers. Let's maybe zoom out a bit and talk about the key principles behind general insurance, the foundations. General insurance covers a huge range, doesn't it? Property loss, liability, personnel loss, financial loss, business interruption.
It does, and underpinning almost all of it is this fundamental principle called indemnity.
Right.
The core idea of indemnity is to put you back in the same financial position after a loss as you were in immediately before it happened. No better, no worse.
Right, so you can't profit from an insurance claim. Exactly. What's fascinating here is how these core principles are designed to prevent moral hazard. You know, stopping people being careless or even causing a loss because they're insured and ensure fairness for both the insurer and the policyholder. There are a few main ways insurers provide this indemnity. They might pay cash check or bank transfer. They might arrange a repair, which is really common with car insurance. They might replace an item, like for like, often cheaper for them than cash, or they might reinstate something like rebuilding part of a damaged house.
Okay, that makes sense. Now, this next bit sounds really important, something called the average principle. You mentioned it briefly earlier with underinsurance. This sounds like a potential trap.
It absolutely can be. It's probably one of the most common reasons for claim disputes or disappointment. So what does this all mean? Basically, if you insure something, your house contents, say, for less than its true replacement value, you are underinsured. And if you then make a claim, the insurer is only obliged to pay a proportion of your loss based on how much you underinsured by.
Can you give us an example? Make it concrete.
Sure. Let's say your home contents are actually worth £30,000 to replace, but you only insured them for £15,000 maybe to save on the premium, or you just underestimated. Then you have a burglary, and £10,000 worth of stuff is stolen. You claim £10,000, but because you only insured for half the true value, $15K out of $30K, the insurer will apply average and only pay half your claim. So you'd only get £5,000 back, leaving you £5,000 out of pocket.
Ouch, that's harsh. What about that Harry example in the notes?
All right, Harry's property. It's worth £300,000, but he only insured it for £200,000. So he's insured for 2/3 of its value. He then has a small fire causing him £1,000 of damage. He claims £1,000. The insurer applies average. Because he was only insured for 2/3, they'll only pay 2/3 of his claim. So £667.
Wow, okay, that really brings it home. Why do people underinsure then? Is it just trying to save money?
Sometimes it is deliberate, yeah, trying to keep the premium down. But often people are just genuinely unaware of the true replacement cost, or maybe inflation has pushed up the value over time and they haven't updated their policy sum insured.
So the lesson is, check your sums insured regularly. Make sure they're realistic.
Absolutely critical. It can save a lot of pain later. Another key term is excess. This is simply the first part of any claim that you have to pay yourself. Most policies have a compulsory excess. You can often choose to pay a higher voluntary excess on top of that. And doing so will usually bring your premium down a bit.
Yeah.
Because you're agreeing to shoulder more of any smaller claims.
Right. Okay, let's apply some of this to specific types of general insurance. Home insurance, buildings, and contents. How do you easily tell them apart? I always think of it like if you could magically tip your house upside down and shake it. Everything that wouldn't fall out the structure, walls, roof, fitted kitchen units, bathrooms, suites, sheds, fences, swimming pools even, that's covered by buildings insurance. Everything that would fall out, furniture, carpets, clothes, TVs, computers, jewelry, pots and pans, that's the contents insurance. Is that about right?
That's a brilliant analogy. Perfectly sums it up. And if we connect this to the bigger picture, home insurance is about protecting your most significant assets, both the physical structure and your personal belongings inside it. So buildings insurance covers the big risks, fire, lightning, explosion, subsidence, earthquakes, storm damage, floods, damage from vehicles hitting the house, aircraft, even animal damage, falling trees. It's quite broad. Plus, it often includes cover for alternative accommodation if you have to move out while repairs are done, liability if someone gets injured on your property, damage from riots or vandalism, theft, burst pipes, oil leaks.
Okay, a lot of protection there. And contents insurance, does it cover the same sort of events?
Pretty much, yes. It covers your belongings against those same perils, fire, theft, flood, storm, etc. But it also often includes extras, like accidental damage cover, maybe cover for belongings temporarily removed from the home, like when you're moving house with professional removers, cover for the contents of your freezer if the power fails. And you can often get all risks cover for specific valuable items, like jewelry or cameras, even when you take them outside the home. This usually splits into specified items, things you list individually with their value, and unspecified items. General cover up to a certain limit per item for things you don't list. But for all contents cover, there's an expectation that you take reasonable care to look after your stuff.
Makes sense. Okay, let's unpack this. Motor insurance. This one's a legal requirement in the UK, isn't it?
Absolutely. It's unlawful to use or even just keep a motor vehicle on a public road unless you have at least a basic level of insurance in force. What's fascinating here is how the compulsory nature of motor insurance underscores its vital role in public safety, making sure victims of road accidents have some financial recourse.
And there are different levels of cover, giving you different levels of peace of mind on the road. What are the main types?
The absolute legal minimum is third party only. This covers your liability if you cause death or injury to someone else, another driver, passenger, pedestrian.
Yeah.
It also covers damage you caused to their property, their car, a wall, whatever, and your legal costs if you have to defend a claim. Crucially, it covers other people driving your car with your permission too, for their liability to others. But it does not cover any damage to your own car.
Right, the bare minimum. What's the next step up?
That's third party, fire, and theft. As the name suggests, it includes everything in third party, plus it covers your own car if it's damaged by fire, lightning, or explosion, or if it's stolen. It also usually covers damage done to your car during a theft or attempted theft.
Okay. And the top level?
That's comprehensive. This covers everything the other two do. Plus, it covers accidental damage to your own car, regardless of who was at fault, even if you just scraped it on a post. Comprehensive policies also often include cover for personal belongings stolen from the car, personal accident benefits if you or your partner are seriously injured, and windscreen damage cover.
And insurers often bundle in extras these days too, don't they?
Yes, lots of add-ons are common now. Things like roadside breakdown assistance, legal expenses cover to help you pursue uninsured losses, maybe a courtesy car while yours is being repaired, help with out-of-pocket expenses after an accident.
For someone with, say, an older car that isn't worth much, would they ever just go for third-party fire and theft? What's the risk there?
They might, yeah, to save on the premium. The risk is obvious, though. If they cause an accident, they'll have to pay for repairs to their own car entirely themselves.
Scrap.
Or scrap it. So it's weighing up the premium saving against the potential cost of repairing or replacing your own vehicle if you have an at-fault accident.
Right. Okay, next up. Travel insurance. Useful for holidays. How does that work?
You can usually buy it for a single trip, maybe just for a week or two, or if you travel a lot, you can get an annual policy that covers all your trips within a year, usually up to a certain length per trip.
So what does this all mean for you when you're planning a trip? What does it actually cover?
Well, if we connect this to the bigger picture, travel insurance often acts as a critical safety net, especially thinking about the potentially massive cost of medical treatment abroad. So, key cover includes emergency medical expenses, often repatriation if needed. Also, trip cancellation or curtailment, cutting your trip short if it's due to illness or injury, yours or a close relative's. Cover if you miss your flight or ferry because of transport delays. Cover for delayed departures themselves. Personal accident cover, loss or theft of your baggage, money, or passport. Personal liability if you accidentally injure someone or damage their property. And legal expenses cover.
Seems pretty comprehensive. Does the type of holiday affect the cost?
Definitely. Anything seen as higher risk, like skiing or other winter sports holidays, will usually mean a higher premium because the risk of injury is greater.
And there's a tax on travel insurance.
Yes, insurance premium tax, IPT. Travel insurance in the UK is subject to IPT, and it's actually charged at a higher rate than standard home or motor insurance. Life assurance and income protection are exempt from IPT altogether.
Interesting distinction. Okay, finally, let's touch on payment protection insurance, PPI. This one has quite a history.
It certainly does. On paper, PPI was meant to cover monthly repayments on a specific loan or credit card for a limited time, maybe 12 months, if you couldn't pay due to accident, sickness, or unemployment.
But here's where it gets really interesting, the history and the controversy.
Exactly. This raises an important question about consumer protection and the need for clear communication in financial products. Because while PPI could have been useful in the right circumstances, it became notorious for widespread mis-selling. People were sold it alongside loans when they didn't need it, or maybe they were ineligible to claim anyway, perhaps self-employed or had a pre-existing condition. Sometimes it was added without people even clearly understanding it was an optional insurance policy with a separate cost. The communication was often really poor.
And that led to a huge scandal, didn't it? Massive numbers of complaints and compensation payouts.
Billions of pounds, yes, though many claims were also rejected. It's also worth remembering the Financial Services Compensation Scheme, the FSCS, generally only handles claims against firms that have gone bust, and the main deadline for making a PPI mis-selling claim passed back on the 29th of August 2019. It's largely a historical issue now, but a really powerful lesson in financial selling practices.
Wow. Okay. We have covered a lot of ground today. We've really taken a deep dive into this pretty complex world of health and general insurance. We've broken down everything from critical illness cover right through to home and motor policies and looked at those fundamental ideas like indemnity and that tricky average rule. We've seen how all these different types of insurance are really specifically tailored to protect different bits of your life and finances. And the aim wasn't just to, list a load of facts. It was to help you get up to speed quickly, get that knowledge so you can navigate this world with a bit more confidence. Understanding these details, these nuances, hopefully gives you those aha moments, helps you make smarter choices about protecting your own well-being, your family, your assets. So as we wrap up this deep dive, here's something to maybe mull over. We live in a world where risks are changing all the time, aren't they? New health worries, digital threats, climate change impacts. How might the whole idea of insurance need to change, need to adapt in the coming years to really keep pace with our changing lives and all these unexpected challenges? Something to think about.